Okay, so now the forecasting principles and the examples that we're going to talk about in the remainder of the module are all based on my book, A Quick Start Guide to Financial Forecasting. And as a matter of fact, you already have one assignment from our previous session, and that's to read the foreword, the introduction, chapter 1 and chapter 2, because I've organized these two modules to follow how I've got the process set out in the book. So as we go along, if you'll take the time then to read the sections from your homework, basically, then what you're going to do, you're going to be diving in just a little bit deeper to what I'm talking about. It's going to help ensure that you really get the principles, because that's a very important part of getting started, is make sure that you got your mindset where it needs to be, because there's a reason why so many people don't have a forecast, or they try to get started and they get stuck. So take the time to read those parts of the book, because it's going to give you a little bit more flavor for what we're talking about here. All right, so what we got to do is we got to know the rules. Before we ever sit down with a spreadsheet or forecasting software, it's important to know the rules, because they set the stage for how we're going to go about the forecasting process, and they help you create the proper mindset, because this is very different than what most people are used to when it comes to analyzing or preparing financial information. So we're going to go through what I like to call the 10 rules for creating a forecast you can trust. The very first one is that it's all about decision making, not precision. So this is about the bigger picture. Directionally, are we headed where we want to go, where we want to take the business with respect to our financial goals and targets? It's not a matter of being precise. In fact, precision is the enemy. Detail is the enemy when forecasting. We want to make sure that we're looking at this big picture, directionally where we're going. We're not creating a forecast and say, hey, our profitability is going to be $333,456. And if it's not that, we've somehow missed. This is more about bigger picture decision making. We're going to talk more about that as we go along, because I'm going to hit each one of these 10 rules, and then I'm going to go into a little bit more detail about each one. The second principle is that forecasting is a top-down, not a bottom-up process. So it's pretty much the exact opposite of how financial statements are created. Financial statements are created bottom up, transaction by transaction, captured at the detail level, rolled up in a general ledger and an accounting system, and then produced in the form of financial statements. A forecast is the exact opposite. It's all top-down, driver-based forecasts and assumptions to create the larger picture about what financial results are going to look like. And when we're talking about a forecast, when I use the term a reliable financial forecast, I'm talking about the three financial statements: the P&L, the balance sheet, and a statement of cash flows. And the very important principle, one thing that gets people hung up, is that say, okay, I'm going to do a forecast, and then they're either going to pull up some software or pull up a spreadsheet and start with a blank slate. That's not how we do it. We start first by understanding what's been going on in our financial statements every month. So there's income, that P&L, balance sheet, cash flow. We're first going to understand those, which means, by the way, that you do have to have a good set of financial statements that are reliable and accurate as the starting point for this process. Then we got to make sure that we have a good sense for the high-level company strategy and expectations. So this is relatively straightforward if you're running your own business, because you are the creator and the person implementing the strategy. In a little larger company, you got to make sure that you understand generally where the leadership team is trying to take the company, because we're going to consider those things as we put our forecast together. And then we've got to always be thinking about, how do I simplify this? How do I simplify? Because you're going to find that there's going to be a whole lot of temptation to dive into a lot of detail and a whole lot of complexity of what happened. Well, what about this? What about that? I don't really know what's going to happen here. I don't really know exactly what's going to happen with revenues. I got a big customer that may not even be coming back in 3 months. All these different things are going to try to cloud your mind. So we got to always be thinking about simplification. And then when we create this process, it's got to be a repeatable process, because we're not putting together a set of a forecast or projections, and then we're going to put it on the shelf like some people do if they were creating a forecast or a projection or something to raise capital or to borrow money. That's not what we're doing here at all. We're going to work this process into our monthly financial rhythm, because it's going to be how we manage performance and drive performance every single month. So we got to have a good, solid, repeatable process that doesn't take a lot of time every month to update and to use as a tool. And then generally speaking, in our assumptions, we want to make sure that we're conservative, meaning that we're not trying to be overly optimistic when we say, here's what I expect to happen. Because there's always a range of, I know you're never going to know exactly what's going to happen on every single level. So we want to be a little bit conservative. Don't go overboard in with your assumptions and create assumptions that turn out to be unreliable. We're always going to be thinking when we get done by looking at our forecast, we're going to condense it and get the insights. And one of the best ways to do that is with the two-minute summary, and I'm going to give you an example of what that looks like in a company here in just a minute. Then really the key to getting started is that you want to start for your eyes only. So if you have maybe there's a CEO, or you have a board of directors, or just have a partner, someone else who is interested in the forecast, interested in where the company's going from a financial perspective. What you want to do when you're getting started in forecasting is you want to create the forecast, get some practice under your belt for a few months where you create a forecast and then you look at the actual results and say, this is what I expected to happen. To the extent that the actuals come in different, you want to look at it because maybe it's just that you're new in the process and you didn't consider something. So what you don't want to do, let's just say you have a couple partners or shareholders or a lender out there who's interested in the forecast. You don't want to get started and be new in the process, create it and then share it with them, and then it turns out to be totally unreliable when the actual financial statements come out. So that's a good way to help kind of get some practice under your belt before you start sharing this with others. Okay, so now I want to talk about just a little bit more detail about each of those 10 rules. So this right here is the devil, and the devil is the face of precision. The devil is going to be sitting on your shoulder going, oh no, you got to build this bottom up. You got to get more detail in here. What happens if you're wrong? How do you know what's going to happen? And it's going to try to drive you down into the detail. It's going to try to make you forget that what we're trying to do is create a picture of what's about to happen relative to our goals, relative to our bigger picture objectives that we're trying to drive toward in the business. They're going to try to drag you into the details. So you have to always recognize the devil's going to be there to do it. That's why you always got to be simplifying and thinking big picture. Because you'll when you get started, I promise you're going to feel the devil there. But what you got to realize is that this is not about precision. That's what you got to repeat to yourself. This forecast is not about precision. It's not about precision. So here's an example. I think that'll help you with that. And what almost every single assumption that we're going to make in the forecast is going to be driven by just two numbers. So the question you ask yourself, let's just say we're looking at the revenue line or the sales line, or what QuickBooks would call the income line, the sales or revenue. The question for you when you're doing a forecast is, what two numbers can I multiply together to arrive at the forecast assumption? It doesn't matter if you sell 1,000 different products or you got 100 different customers. We're not going to make estimates at that level and then try to roll it up. For this process, there's some planning that you might be doing, especially if you're trying to grow your business, where you're going to look and see, here's the kind of revenues I'm trying to generate. What kind of leads does that mean I have to generate, and kind of bring it back to shorter term goals. But with regard to the forecast of an income statement or P&L, balance sheet, and cash flow, we're doing this big picture, and this is the test, the two-number test. So let's take a look at that. What two numbers can I multiply together to get my revenue assumption? Here's a couple examples. In a retail store, it might be number of customers times average ticket. So it's really big picture, and you're going to see when I show you some of the examples coming up in just a little bit, how we're going to, when we look at your historical results, you're going to find that there's some relationships, there's some drivers at this big picture, two-number kind of level that are going to help you make some of these assumptions. It may seem hard to believe at the moment, but I'm going to show you some examples so that you can see that. Then in say a professional services firm that bills by the hours, it might be total hours incurred for the month times the average billing rate. For a wholesale distributor of gasoline, it might be gallons sold times average selling price. But the key is we're going to go to what two numbers can I multiply together to get my revenue assumption. We're going to basically do that for every assumption that we're making when we create this forecast that impacts profitability and cash flow. Okay, and this is one where I have to always remind, especially those who are financially oriented or accountants, if you have an accountant or someone helping you create your forecast, is that this is a top-down process, not bottom-up, because the accountants, and I've been one for a long time, been a CPA since 1985, we are taught that financial information is a bottom-up process, but forecast is very different. It's all about the top-down. And one way I like to emphasize that is to say, how many people will you have to rely on to provide you with accurate estimates for your forecast? Because a lot of people say, well, I got 5 salespeople out there. I need to send them an email and say, hey, how many prospects do you intend or expect to close over the next 3 weeks or 3 months, and about what value will that be? And then you bring all that together and roll it up into your forecast. No, we're not doing that at all, because the number of people you need to create the assumptions for your forecast is 1. And that person is you, and you're looking at them when you get up in the morning and look in the mirror. This is a one-person exercise, what I'm teaching you here about creating a reliable financial forecast. Okay, and I mentioned that one of the biggest mistakes people tend to make is they're going to pull up a spreadsheet or pull up forecasting software and just start with a blank slate. No, we never do that. We always lay in the actual results. And you're going to see that when I show you the example of the construction company. I call them ABC Construction Company that we walk through in detail in the book. I'm going to pull that forecast schedule up for you, and I'm going to show you the historical information that I pulled together in order to begin the forecasting process. And then we're always going to condense things to the 2-minute summary, because for at least for those of us who have a little financial nerd inside of us, we tend to do our work, create financial statements in a forecast format, and then we go plop them on someone and say, hey, here's the forecast, and pat ourselves on the back. No. We glean the insights from the forecast. We find out what decisions this forecast is helping us to make, what goals and targets, and how do they relate to the forecast, and what does it mean for whether we're driving toward our goals or away from them. Because Einstein was quoted as saying, if you can't explain it simply, you don't understand it well enough. And by the way, this is equally applicable to your historical financial statements, the financial statements that you get every month. If you can't sit down with someone, maybe it's your spouse, maybe it's a partner, maybe it's someone else in senior management at the company, but you should, when you look at your monthly financial statements, income statement, balance sheet, don't just look at the income statement or P&L, and cash flow, there should be a look there. If you can't condense what it's telling you to a 2-minute conversation, then you're not really gleaning any insight from those financials. So you really need to take a good hard look at how you are using your historical financial statements, because the same principle applies. So here's an example where a 2-minute summary that was put in writing says, based on our growth plan for the coming year, we'll need to raise $1.1 million to $1.3 million in cash by June 30th. And this was a forecast that we put together with a CFO, so we were presenting this in a larger company to the CEO. The primary driver of the need to raise cash is the plan for launching the new division in Texas. The expansion is forecast at $3 to $3.5 million, driven primarily by the capital expenditures and the first-year operating losses. So all the work that went into this forecast, boom, we nailed the keys that, in this case, the CEO wanted to know about, because all the assumptions that we put in there, everything came down to, all right, how much cash are we going to have to raise, and why are we going to have to raise that cash? That's what a 2-minute summary is all about. Okay, so and remember, especially as you're getting started in forecasting, you want to get started for your eyes only. You want to get the process rolling so that you're projecting, say, the next 3 months. So we have a fairly short window we want to look at. And then when the actual results come in, we're going to look at it and say, how did I do? I create my expectation of what P&L, balance sheet, and cash flow were going to look like. How did the actuals come in? And if they're different, why? So you do that for a few months, you'll find that you start getting really good at it. You begin to learn more about the financial statements, which is a very healthy process. And so you don't go out too early sharing that with other information. You want to keep it for your eyes only.